Hello guys. Today and tomorrow we have earning dates of Twitter, Apple, and tomorrow we have Facebook. Now, why earning dates are very important? Okay? Because if the company has made more profits than what the analysts say, the stock most of the time will have what we call a gap up. It means a lot of people they buy just because of the good news. Now, if the earnings are less than what the analysts say, we will have either a gap down, which is people they go and they short, and in either ways it's an aggressive trading. Now, what does it mean, aggressive trading? It is very risky. Now, if you want to play this game of earnings, you should be prepared of the two ways, either reward or loss. Okay? Now, it means if people they don't know, why do they do this thing? Yes, because a lot of people, especially professional traders, they like risk. Okay? Now, I have done this before a lot of times with Facebook, with Twitter, and with other stocks. Okay? That the news has a very important thing on the stock itself and the price. Now, in general, for me, I don't follow anything than the price, but earnings dates for some stocks, not all the stocks, has a very important impact on the price. Now, let's say you want to do this game of earnings date, so you can do it in what we call paper trading, just like say buy 100 shares or 50 shares or 1 share. If you want to use your money and you are scared, it's better not to do it. But even if you are scared, you can, for example, if you don't want to lose that much, you don't want to earn that much, you can buy 1 share. For example, if you don't have money, for those who have no money, let's say he has $1,000 or $500 or $2,000, and he wants to play this game, you can buy 1 shares or 2 or 3, and then you feel the thing about earning dates. Okay? And whatever you lose, for example, if you lose $10 or $20 or $30, okay, from $100 or $200 when you buy, okay, it's just a way to practice. Now, if you don't feel you want to risk that much in trading, so avoid the earning dates. Now, what do you mean you avoid earning dates? It's very easy. Let's say you buy a stock. Let's say you buy Twitter 2 weeks ago, and you know that today, which is Tuesday, 26th of April 2016, today there is an announcement of earning dates when the market closes. It means after the company, any one of the company guys, he announced the result from the earning of the company, the real earning of the company, and he just announced it. Now, you have the choice either to sell your shares today before the closing. Before close, it means before 4 o'clock. If you don't want this trouble, just sell. If you own, for example, today, if you own Apple or Twitter, and you don't like this kind of gap up or gap down, yes, if it is gap up, I know you like it. You say, oh, I bought 2 weeks ago or 1 week ago, and then maybe the stock goes that high and they make money. Now this is, I know you like, but in order to lose, you don't like. So here, it means you want just the good thing. You don't want the bad thing. But if you are a true trader, you should expect both. Expect a gap up or a gap down, and you should be okay with it. Now, if you don't like, you can sell today before the close. I'm telling you, if you don't like the, maybe the stock goes down and you lose a lot of money. And then for those who have never heard about earning dates, they don't know why the stock goes down and why the stock goes up. It's just speculation. And millions of traders, some they short the stock thinking that the stock will go down, they short it, and some they buy it in order, they think that it is a gap up. Now, who wins? The most powerful wins. Okay? The most powerful, because it's always about supply and demand in the price. If the demand is too much, like when they see good news, a lot of people, even after the market close, some people, they just begin to see. This is another technique if you want to use it, but it's too. You should be so quick and you have a good broker. Okay, what you should do, you just buy when you see the stock is moving after the close. Okay, but here you should be so quick for this. Okay, now today we have Twitter and we have Apple, 2 stocks. Okay, we will see for today. Now tomorrow, which is Wednesday 27, we have Facebook. It's the same thing after the close. Now, if you like risk, you can buy some shares or something just to try if you want. If you don't want, if you want just to be a watcher, you just watch how the price goes up because of this news, or how the stock price goes down because of the news. You can just put them in a list or check them. Okay, at 5 o'clock or 6 o'clock, check the stock and see what does it do. Does it go up or does it go down? Okay. Now, there are some people who do what we call day trading. They just wait until the news comes, and they know what it comes because it will be announced at the time. So they will just begin waiting. Whenever they see the stock begins to move, they buy. And after a few minutes, they will sell with a profit. This is a day trading. If you want to let it for tomorrow, this will be swing trading. Okay, you want to see after tomorrow what will happen. It means, does it go more and more and more, or does it go down and down? Okay, so this is just this video is just to show you. I have done this before, and I announced this. Is just to get acquainted with this transformation in the price. What pushes the price to go up so much, and what's this force that push the stock to go down? This is because of the news of earning. Each 3 months, the company announce the earnings. Now, today, it's not where they give the dividend, or for those stocks they have dividend. Dividend is later, okay? But now it's just to announce the result, and they compare the earnings of this quarter to the earnings of last year. if it is better and better than analysts, what they say, because the analysts, they just predict. Okay, they say okay, they just predict and they give a number. Okay, and this number you will see it, like let's say 50 cent for each share, or $2, like Apple is $2, I guess, and I think Twitter is 56 or 70 cents. Okay, now if what they announce, it means the company announce better prices than this. Let's say Twitter, they say 70 cents. The analysts say 70 cents. Okay, this is what they get per share. Now, if the company announced $1 or $1.50, it means that the company has done better this year and the stock might go up. Okay, but all this what we call the quarters that we have seen before, they were so bad. Okay, and it's not that big deal. Okay, so we will try to see what's going on today, and tomorrow you will see the real results in the morning. Before the market opens, you try to check, let's say at 6 o'clock or 7 o'clock a.m. or 8 o'clock, and you check what is the price there. Is it a good one or is it a bad one? Okay, for Apple, I think it's $2 per share. Now, if the earnings is more than $2, like $2.50 or $2.25 or $3, so I think the stock will go up. But if it is bad and it's not like what the analysts say is worse, it might be they short it and the stock will go down. Okay, so it's all about betting on the price. Okay, so those who like risk, they do it always, and those who don't like risk, they don't do it. So if you own Twitter and Apple today, if you don't like risk and you have stocks, you should sell them. If you don't like risk, but if you like risk, stay. For those who want to buy, you can. They don't want to have a big risk. You can buy 1 share or 2 or 3, depending on your money, depending on your risk. Okay, it's not that big deal. And for those who don't want to do anything in the market, they want just to watch. Please watch. Today we have Twitter and Apple, and tomorrow we have Facebook. Okay, after the closing, they will announce. Just go and check the price, how it is moved, how it is pushed, and this is practice. The more you practice, the more you understand the things that push the price up and down. Although it's always supply and demand, but the news is the one that it's not the news that push the price itself. No, it's the opinion of the traders. If they see good news, they try to buy, but sometimes the opposite happens. Although it's a good news, but the stock will go down. Okay? So there is nothing that it is sure in the market. That's why I always say to the people, okay, and the traders, you should not seek sure thing, because it doesn't exist. And if you are following a sure thing and you are following people who said they will give you a sure thing, you will fail, and they will fail in the future. This is for sure. The sure thing is the supply and demand. If a lot of people, they buy millions of shares of Twitter and Apple, believe me, there is a gap up in the morning tomorrow. But if they short it, and some they sell because they don't see the news are bad, so the price will have a gap down. But it's all about betting and about having an opinion in the market. No one knows right now. No one knows, because if someone knows, he will buy right now before the market closes. Okay, if I know that for sure 100% that Apple will go up or Twitter go up, okay, what should I do right now? I buy all my money with these 2 stocks. Okay, you understand? So there is no sure thing. You should just bet and wait for the news and what the other traders will do. Okay? And then we will see the results. Thank you very much for watching this video. If you have any questions, as usual, just ask. And tomorrow I will do a video and explain what did happen for today for Twitter and Apple. Okay? Because Facebook, it's tomorrow. It's not today. Thank you very much and have a nice day.